Good morning and welcome to the Post-Monetary Policy Committee press conference. Today is the 30th of March 2021. The Monetary Policy Committee held a meeting yesterday and did its usual press release just sent out to everyone and is available for everyone to see. As is usual, we are hosting a post-MPC press conference which will be addressed by the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge. He will run through his statement, and after that we are able to take questions and answers. If you'd like to send those through, please do so through Slido, SLIDO. The meeting code is Slido MPC03. That again is #MPC03. Without further ado, I would like to hand it over to the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Hello, good morning, everyone. This is the second briefing this year after an MPC meeting, and it also marks 1 year since the emergence of COVID-19 in Kenya, and of course the fight against the ravages of the pandemic. So before going any further, I want to acknowledge those that we have lost: families, family members, friends, colleagues, strangers, and especially the health workers who have worked and some of them died that we may ourselves live. I also want to acknowledge the heavy toll the pandemic has exacted on families and communities. So even as the MPC met yesterday, there was more than the usual retrospection, meaning we also looked farther back and how the year evolved, and indeed how effective were the measures that we had implemented over the last year. But I will follow the general pattern that I've used before. So first I'll discuss the global developments as the MPC saw them, and as, in a sense, anchored the outcome of the discussion. So the most significant development so far is the rolling out of the vaccines around the world. That has buoyed up hope that the pandemic could end soon. If you made something like the image of a dove returning to Noah's Ark with a twig in its beak comes to mind. Nevertheless, there are concerns about the pace of the deployment of these vaccines, and importantly, their availability of vaccines to low and medium income countries. No one is safe until everyone is safe. It's therefore important to make sure that those vaccines are widely and quickly distributed. There are also concerns about the renewed virus outbreaks and their reintroduction of containment measures in specific economies. Accommodative policies and large stimulus impetus have also supported the economies in the advanced economies. Now, in terms of numbers, the early numbers for the rest of the world, global numbers, and in particular the advanced economies, those early numbers indicate strong rebound in key advanced economies and indeed emerging markets, China in particular, India as well, and of course increased business confidence. However, looking at those early numbers, we still await the WEU updates, that's a World Economic Outlook update that will be circulated by the IMF on Tuesday next week, so within a week. But we expect to see significant upward revision in most of those numbers, and in particular the global growth numbers. That said, there are huge uncertainties about the magnitude, and particularly over the medium term. So I guess the catchword going forward, or the watchword going forward, is one of uncertainties, uncertainties, uncertainties. Moving then to the domestic economy, The first item I wanted to deal with is the external sector. And Kenya's external position continues to improve. The current account deficit is estimated at 4.8% of GDP, that is at the end of 2020. So the current account deficit for 2020. And if we could probably look at the charts, if they are available. The exports, as we can see, continue to grow. And actually in the year to February 2021, they grew by 1.2%. And the chart that you are now looking at shows the specific, let's say, categories, large categories. But this compares to the decline that was observed in 2020 through April, May. And in particular, merchandise exports, they grew by 1.2% to February. Tea exports, as you can see, grew by 8.1%. Horticultural exports also grew strongly at 3.4%. Manufactured goods fell by actually marginally 0.2%. But it is interesting that our manufactured exports are now flat after a period of significant decline. So in a sense, there is also some optimism in that sector. In terms of direction of trade for the merchandise exports, one-third of our, manufactured exports. One-third of our manufactured exports are destined to Uganda. And 3/4 of our manufactured exports go to the entire East African community region. And these are mainly cement, iron sheets, steel, etc. On imports, maybe there's another slide we could move to. This declined by 11.8% through February, largely due to lower oil imports. And I think we know why that has been the case. It's because of the decline, substantial decline in the price of oil, price of crude. Interestingly, intermediate goods excluding oil, these have continued to grow. So they've sustained growth since September of 2020. And actually for the period September to February, those 6 months, relative to 6 months in the previous period, was higher by 8.6%. So if you looked at just September 2020 through February 2021, the growth relative to a similar period a year before is for intermediate goods excluding oil is 8.6. This shows that there is dynamism in the various production sectors in the country. Moving on to remittances, this remains strong. And I don't want to belabor the point here, but for February it was $260 million US dollars. That's what we received, which relative to February a year before is a growth of 18.9%. But I think the point here is that last year we saw substantial increase in remittances, and these are sustained, and we expect this to continue going forward, maybe at a slightly more moderate pace, but we expect that growth to continue, and we'll mention something about it at the end of my intervention. I'll also mention a few other things about capital inflows at the end of my intervention. Bottom line here is that the current account has continued to strengthen, and for the 12 months to February, it was equivalent of 4.6% of GDP. That's the current account deficit. And we expect an outturn for the year 2021 of 5.2% of GDP. You can see on the slide that is shown there that reveals an adjustment in the current account. And as I have said before, we expect our current account to stabilize around 5%, which is where it is now, of GDP going forward. A couple of other points to mention, which I'll come back to also later, is that we expect a significant reserve buildup towards the end or at the end of 2020. So by the end of 2020, we'll have accumulated significant reserves. Also, we expect and we see very strong prospects for trade with the signing and coming into force of the recently of the agreement between the trade agreement between the UK and Kenya. This all bodes well for an improvement in the current account and indeed the rest of the production sectors. Now turning to the real sector, the trends that we observed and reported in January have been sustained. But in particular, there has been some changes, and I think here I would just say that we did look at some leading indicators which were revised up, and in particular cement production in the year to September, but they were revised up during 2020 and significantly. Also, there is the private sector credit that has actually grown quite well at 9.7%, and it's the highest it's been since June of 2016. All these collaborate that, and the other data that we had mentioned before, collaborate that the economy has continued to strengthen, or the dynamism that was taking root in the economy towards the end of the year has been sustained. But we await the preliminary estimates for 2020 that the Kenya National Bureau of Statistics should be releasing in the middle of next month, mid-April. So on the basis of those numbers, we will of course revise our projections, etc. So in some sense, we did not present the MPC with new significantly different projections in terms of the direction of the economy. We updated it in terms of the new information, but we await the new data to have a significant revision of all the numbers. But still, agriculture remains strong. Construction has remained strong as well. And education, as we had mentioned last time, we expect it to rebound in 2021 because indeed now the learners are back at school, at least are back in a sort of regular calendar of learning. Still, looking ahead, the prospects for 2021, I think these are anchored by the points I mentioned before, but I would want to stress a couple of things. First, the new containment measures that were announced last Friday. These, we noted them as being very selective, parsimonious, and in terms of location, and indeed, work continues within the one zone area. So unlike a year ago where most of the economy came to a standstill, here in Nairobi, for instance, there was, for a period of time, there was very little traffic even. I think the point here is that the rest of the economy will continue, of course, insisting on the use of or following of the protocols that Ministry of Health has indicated, continue to remind us. But in terms of the economy, it has a selective impact in terms of the region and in terms of the sectors. Still, it is important to note that an important unknown in this is how long it will last. So I think the point here is none of us know how long those containment measures will be necessary. And it seems to us that what we'll do is obviously when we make the revisions, we'll have a better idea as to how long this, how successful they are. And therefore, what is the prospect of lifting them in the next month, et cetera, et cetera. A second point to note is that services sector was the weakest sector in 2020. That is the sector that took the blunt of COVID-19 containment measures, the closures that we observed, etc. Now, looking at them, hotels and restaurants, for instance, clearly in the current regime, a lot of those will continue, a lot of them will continue as before. But I think the point here is that they have also learned and they had reopened. We'll talk a bit more about what we have learned from the hotels and restaurants. I mentioned something about education, how that sector will reopen or has reopened. And of course, wholesale and retail and transport, those sectors are good indicators about the rest of the economy, and particularly on consumption, consumption, general consumption. And those actually are sectors that we have already begun to see. The leading indicators from them show the resurgence there's a resurgence of the economic developments there, improvement. I now want to turn to the banking sector, and the sector remains stable and resilient, and liquidity is adequate and well distributed. The major risk there remains credit risk, and that remains elevated. We mentioned that NPLs, non-performing loans, as a share of gross loans, that has risen marginally to at end February, had risen to 14.5%, marginally from 14.1 in December. However, adjusting for the provisions that have already been done, have already been incorporated, the ratio stands at 5.8%, which clearly is manageable. We also did the what-if scenarios that I mentioned 2 months ago. We redid those scenarios, and we see now that they are peaking at 16%. This is the NPLs to gross loans. They'll peak at 16% in June, which is down from 17%. 2 months ago, when we did this scenario, we saw that they would be peaking at 17%, but they've come down to 16%. Still, it's in the same order of magnitude, but at least we are comforted that this is not a sort of a runaway problem, and it is well contained. As of the measures that were there, the significant restructuring of loans that were performed, or that were, sorry, the significantly, the restructuring of loans that were performing on March 2nd, 2020, that, as we had announced earlier, 1.7 trillion Kenya shillings worth of those loans were restructured. That is 57% of total loan book of the economy, as it were. And at end February 2021, 569.3 billion Kenya shillings worth of those loans, that is 1/3 of them, were outstanding. So the other 2/3 had matured, had been repaid, etc. So only 569.3 billion was outstanding at end February. And of this, that were outstanding at end February, over 95% of them continued to be, were up to date. So payments, etc., were being done according to the terms of those loans. And only about 5% of these loans were not up to date with their repayments. So you can see that the problem here is quite contained, quite contained. Now, one more point I would want to mention here in terms of the banking sector at this point is that banks, as you know, are required to submit their internal capital adequacy assessment plans, in our jargon, ICAP, by end of April every year. So at the end of April every year, they have to submit to the central bank their ICAPs. And we assess this. We also discuss it with them and see, and then have clarification, if there are any clarifications, et cetera, et cetera. However, for 2020, we had, of course, they were required to submit them by April of 2020. But in August, given the developments of the pandemic, in August of 2020, we requested them to update their ICAPs. As you can imagine, it was clear that what had been submitted earlier was no longer relevant. It needed to be validated, as it were. And these were to be submitted to us by October of 2020, which the banks did, and we have been discussing it. We discussed it with them. Now, we have engaged them, and they have satisfied us that their plans are appropriate. Mind you, at that same time, we also asked them to engage us before distributing their 2020 profits. And so we have engaged them and agreed with them, or in a sense, they have convinced us that their plans are satisfactory, and their plans for dividend distribution, whatever amounts that they specifically would want to have, etc. So that's really the bottom line in terms of the discussions that maybe now you've been seeing some of the banks are making decisions, withholding completely some of it, or their dividend. Well, that is really the consequence of the discussions that we have been involved in. But I think it is important to appreciate that actually the institution themselves and the shareholders, so all the way from management, board, and shareholders, are in that sense very responsible for those decisions that they make in their institution. I want to make a few other points, and the first one I would want to make concerns the fiscal commitment that we have seen to fiscal consolidation. I think there's a slide I would want to show you. And in that slide, yes, so here you have a plan for the fiscal consolidation for the country. And you can see we are in 2021. And a year ago, before COVID, our expectation was we would have brought down the deficit to 5.9% of GDP. But in light of what happened and the measures that had to be done, that deficit has increased to 8.7%. And we expect to have to reduce or to consolidate the fiscal position, meaning strengthen the budget along the path that is shown there. That is 7.5% next fiscal year, 5.6%, and eventually in 4 years around 3.6% of GDP. So that consolidation path is what was presented to us. Indeed, also the details of revenues, et cetera, for consideration by the MPC. And we obviously saw this, noted this strong commitment to fiscal consolidation. Now, we also note that the National Assembly has approved recently the supplementary budget, and therefore will be this budget will actually anchor the 8.7% of GDP, the deficit that we mentioned a moment ago. So that is something that I think is a major step forward in terms of the entire, let's say, breadth of policy policies in the country. I should also have said that in this year, or this this month, we actually conducted 4 surveys. You are very familiar with the market perception survey, and also we have been conducting over the last few months 2 other surveys, one of which was the hotel survey, and the other one was the flower farm survey. And this time around, we also included a new survey, which is the CEO's survey, meaning the survey of CEOs. So going back to I just want to highlight the big items. First, on the market perception survey. And here you can see there is significant optimism, both by banks and non-banks. And I think you can see that that optimism has risen. In March, you can see there is the blue and the gold. If you are adding if you are adding the very optimistic and the optimistic, those are the ones at the top. And also the optimism by banks, again here. And I need to confirm whether the colors are switched, but I'll leave that for now. We will be putting out these slides in the entire survey, outcome of the surveys, in the next 2 days on our website. Going on to the next one, this is the survey of CEOs. This is the first survey that we've done. Unfortunately, the response rate was rather low, and we presume that next time around we'll have many more CEOs responding. But I think the point here is that the growth prospects appear good for their own companies. You know, a lot of them have expect that over the next 12 months their companies will do better. You know, they are optimistic that they'll grow, and you can see that between the higher and the same, you have a significant amount, or let's say those that are pessimistic think that things will be worse, lower in terms of growth. You have for the companies prospects 15%, and for the sector 22%. And this is anchored on the rollout of the COVID-19 vaccines, which signal control against the worst effects of the pandemic, and of course the continued reopening of the economy. Now, I should say that this was done before the measures that were announced before the announcements of measures on Friday last week. Now, there are also some concerns that came up, and I think those also will be put out in the material. And I think a lot of it concerns sort of the cost of inputs, etc. Now, on the next survey, the one on hotels, we can see that almost all the hotels, the responding hotels, were open. All of them actually, 100%. And the only ones that were not open were the hotels that were in the rest of the country. Virtually 100% of them were open. And in Nairobi, we have 96% of them were open. So there are still some that are not open for a variety of reasons, but those numbers are good. The issue there was actually the occupancy numbers and bookings, etc. Obviously, that now has changed quite dramatically in light of the lockdown, particularly those that were going, let's say, had planned to go to visit somewhere up country or the coast or whatever for Easter. Those numbers obviously are changing. And then finally, the the survey on farms, the flower farms. And you can see the number we would want to show here is one about the employment. Basically, employment has superseded or the levels, pre-COVID levels. And in terms of production, farms that are open and all that, yes, they are at about COVID levels. And the orders are significant, and they are at around COVID levels. So the flower farms are pretty much, they've recovered, both in terms of employment and in terms of production. Of course, they would want to do more, and they do see the constraints, and one of the constraints that still remains is on cargo space. That is the one that actually we had more about, and all that will be in our in the material that we're going to publish over the next few days. Before I finish, I want to mention a few things. First is that we are going to have a Diaspora Remittances survey, and that actually is already running. We sent it out. It's by an online survey, supposed to be supposed to survey our diaspora wherever they are. And we are working with the Ministry of Foreign Affairs on this, and they've been very helpful in terms of pushing out the surveys to our fellow Kenyans around the world. And the point here is simple. We want to assess, to understand better, first, how the diaspora send back remittances, both cash and non-cash. And if there are any constraints, what constraints are there? What constraints do they face in terms of cost, in terms of timing, all the constraints. So we want to understand better. And secondly, we also want to understand better how could they be more supportive of investments back here. As you can imagine, there are all sorts of ways that the Kenyans out there could be supportive, not just making investment in government securities or other assets, in the Nairobi Securities Exchange, equities, etc. No, not just that, but also other things. They can set up shop here in various ways. They can actually have direct investments, not just portfolio investment, as has happened in other countries. If you look at, for instance, India and other countries, the push there was largely, particularly in the IT sector, was largely the diaspora from those countries. So we need to understand better, because this can very well be a significant, let's say, counterweight to all the pressures that come. So it can actually be a significant help in terms of investment, in terms of employment, etc. So that's one of the things that is there, and it is also on our website for those of you that may not have received the link. Secondly, we are still working on the digital lenders, and I think the point here is that we understand the concerns that have been put out there of the unregulated digital lenders, and the impact, and should we say the social problems that they have wrought, particularly on the most vulnerable. And so we had been working with the parliamentarians, and there is a bill, an amendment bill, that we had been working with the late Honorable Oyoka, and this bill had passed the various stages, and had actually been put out for public participation, etc. So it was very much at the last stages of its sort of approval, of the approval process. And that's the bill that we are working on, and hopefully in the very near future, it will be pushed through to go through the final stages, or the stages that remain, and hopefully in the near term we will have it in place, and we can begin, in a sense, resolving this long outstanding problem. Another point I wanted to mention is the recent action by the global rating agencies. I think recently that's at the beginning of March, Standard & Poor's, one of the global rating agencies, lowered its long-term foreign and local currency sovereign rating by 1 notch to B from B+. And this is, they cited rising fiscal and external pressures. However, the outlook was revised to stable from negative. Now, one of the things that we saw in their sort of arguments about this was actually the issue of the outlook for over the medium term. And this, we have insisted that it is very uncertain. As I mentioned, given the circumstances of COVID, not just Kenya, but all around the world, I mean, uncertainty is really the byword. And, but at the same time, we do have, at least in Kenya, we have significant, the prospects are actually quite positive. And frankly, we found it a bit surprising because our projections for instance, 2021, growth in 2021, are quite high. Frankly, global growth is supposed to be quite significant. I believe it is something like 5.5%. So from our perspective, I think the numbers that we have been looking around, National Treasury, for instance, had a number like 7%. We had a number at one point of about 8.3%. The IMF has a number of 7.6%. I'm not saying that these are point estimates, but they are far away from, say, the 4% or even the 5% that we were talking about maybe a year and a half ago, and indeed others may be talking about. So from our perspective, the outlook is stronger than maybe was acknowledged by this global rating agency. Just on Friday, Fitch Ratings also put out its own rating, affirming Kenya's long-term foreign currency rating or at B+, so they did not change that, with a negative outlook. Now again, the B rating reflects a track record of strong growth and relative macroeconomic stability, and according to them, a favorable government debt structure, which we have, of course, been involved in. But I think the point again is that the medium-term prospects are much better than maybe is acknowledged in some of these discussions. I already mentioned the general what underpins the medium-term projections, and indeed also one should understand the fiscal direction that I mentioned, and you have the slide there. That's all I wanted to say about those global rating agencies. And then finally, you are aware that we have had sort of ad referendum agreement with staff of the IMF on a program, and we expect that that program will be discussed at the IMF board on Friday, April 2nd. And it is actually a 38-month program underpinned by arrangements or amounting to 1.248 billion SDRs, which is about 2.4 billion US dollars. And we expect that this will be approved sometime on April 2nd, that is on Friday. And then very early next week sometime, there will be the consequential disbursements. We'll receive the disbursements of about $314 million US over the next few days after that. The bottom line here is that the program is intended to support our COVID response, and actually it will provide direct budget support. So that is financing that will go directly to the budget. And also, in terms of other policies, it intends to anchor debt vulnerabilities and reduce them. So in some sense, this is the key element of this program. So it anchors the fiscal consolidation through revenue-driven policies, and thereby reduces the debt vulnerabilities over the medium term, which is one of the things that I think we have had conversations about, etc. So on the back of this flows, and indeed other flows from the World Bank, for instance, we'll be getting a DPO from them later in the next few months, before the end of this fiscal year. There will be significant concessional flows that will be supportive of the government, and indeed also of the reserves, as I mentioned earlier. So on the whole, I think those are the points I wanted to mention, and I know I've ran past my allotted time, and I'm open now to your questions. Thank you very much.
Thank you. That was the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge. And as we usually do, we will take questions, and I will do the first batch of questions. The first question is from George Obulutsa of Reuters News. And his question is, during your last press briefing, you spoke of Kenya planning to reconfigure its external debt. What is the latest update on that? The second question is from Njoroge Kefa of Radio Citizen. He asks, when should we expect the rollout of the risk-based pricing model for banks? Commercial banks have been waiting on the CBK for this. The final question in this batch is from David Herbling of Bloomberg News. David asks, is the Central Bank of Kenya concerned about the widening of the output gap by the new virus containment measures, and what can be done to boost growth?
Okay, fine. So let's deal with this. So George's first question, reconfiguring external debt. I think you remember, George, there was the debt paper that was circulated. It's on the national, it is on the National Treasury's website. And also you have looked at the material that was sent to the National Treasury and to the National Assembly and have subsequently been approved. So basically the point is, first, we will take advantage of the DSSI, which is the debt suspension, debt service suspension initiative of the G20, which which ensures that during the period, the next 6 months or to June, the payments that that should have been made to the G20 creditors are suspended, and they are consolidated and distributed over 5 years going forward. So that's one specific element, and I think the point here is that that is ongoing. That is something that was announced before and is ongoing. The other elements of this, of course, there are specific, there's a specific action with regard to some large payments, that is large loans, bonds, and in particular the Euro bonds. And there will be some consideration of borrowing so as to, in a sense, reduce our the cost of our debt. So in a sense, switch expensive debt to cheaper, debt, and that is also part of the reprofiling that was mentioned. So, in a sense, this is something that is ongoing. So there's no big bang kind of situation where we are going to wait and do it all at once. It's being done incrementally. But I think, as I mentioned before, the most important element about it is not the sort of, that operation. It has to be underpinned by fiscal consolidation. That is really the most important thing. And if we don't have fiscal consolidation, then whatever we are doing, we're just moving, let's say, chairs on the deck of the Titanic. Then the second question is on rollout of the risk-based pricing model for banks. Frankly, Njoroge, I don't know what this is about. I already explained where we are in terms of discussions with banks. There are misconceptions out there, and as long as there are misconceptions, I don't think I want to, to sort of pour fuel on fire. I don't think that that's the way to deal with this. We are in touch, as I mentioned, to all the with all the banks, and been doing all this in a straightforward way. And I don't know what this is about. That banks have been waiting, and I quote you here, commercial banks have been waiting out on the CBK for this. I don't know what that is. Then moving on to the next question. Widening output gap. I think, let's be honest, David, output gaps generally make sense when you are close, when they are small, right? That's when you use your fiscal and you want to call it demand management tools to close the output gap. So the point here is that we are very far away from trend, or from what you may call the economy's sort of potential output. Very far away. Why? Because actually various sectors have been closed out, hotels, et cetera, as I mentioned before. So services, that's really where the largest output gap is. So measures have to be dealt with, have to be brought to bear to close that gap. But what sort of measures? It isn't demand side measures. It's really other measures. When we are talking about, for instance, hotels, it's no amount of demand management will close that gap. So these are the structural reform measures, if you want to call them that, or other more general structural measures that one can put in place. Now, the new containment measures, I mentioned it a moment ago, we don't know the duration, so we need to see what, we need to be a bit more concrete about it. So I think the point here is give it a bit of time to understand better. I mean, just within the last 1 week, or the last few days really, or over the weekend, there was more, let's say, understanding as to how these measures will play out. But again, as I say, there are a lot of areas that are untouched by these containment measures. That is, if you're outside the one zone area. And secondly, even within the one zone area, there's a lot of activity, economic activity that is taking place. So that's what I would say for now.
All right, the second batch of questions, I will begin with Brenda Kerubo from KTN News. These two questions are related from Brenda. One is where she asks, are you worried about job cuts with the latest containment measures? She also continues with a second question, which is related. With a fresh rollout of the measures, wouldn't it be prudent to extend the stimulus program to cushion vulnerable citizens and businesses? Back to Njoroge Kefa, who asks, on average, the banking sector is stable. A few banks are, however, showing vulnerability on regulator threshold, i.e. capital and liquidity. How is the Central Bank of Kenya handling this? The final one from this batch is from Faisal Ahmed of Citizen Television. Will the CBK relook at the emergency measures on restructuring of loans for bank borrowers, given the new containment measures by the government?
Fine, thank you. So let me take the question by Brenda, one of our questions, and together with Faisal's question. Actually also throw in there Njoroge's question. I think the point here is that we, as we said in the press statement, we are monitoring this continually. So you do not say, you cannot say never, never say never kind of thing. Yeah. So if the measures, if things turn out that additional measures are needed because things have really worsened, then obviously the MPC and other authorities or all the other policymakers stand ready to deal with that. In some sense, there's always that sort of those measures that you may have in the back of your pocket, you know, sort of back pocket as it were, that you could unleash as needed when if things get worse. But at the same time, you have to appreciate that for every measure, particularly the ones that you mentioned, the restructuring of loans, it comes at a cost. And so you have to balance it against the cost of those measures. And the cost here potentially is to the depositors. So we are conscious of that. So even as maybe you, from your perspective, you're only looking at it from the borrower. The borrower, for every borrower there is a lender, and behind the lender is a depositor. Those funds belong to somebody else, you, me, whoever, as a depositor. So it is important to safeguard that. That's why this is not, there's no such thing as a free lunch, as you say. So that's why we have had to balance these things and also determined that this is the time to actually end them, meaning not extend them, because the situation, as I said, has improved, as I explained. And also we noticed that a lot of those that got the restructured loans actually did benefit from them and improved, meaning got out of the loans, or if they are still there, they are more than 95% of them are actually current with their loans. So that is really the approach here. At the same time, of course, you need to be clear that you don't want to introduce bad behavior. You know, bad behavior is very difficult to break away from. So the idea of being regular with your payments, that is very important. That's very important for all of us, for the borrowers, the lenders, everyone else. So I think the point I would mention here now is just we will look at all these measures as needed, and we stand ready to use whatever means, whatever tools are necessary, if indeed they are needed. Njoroge asked about banks' vulnerabilities. I think the point here is that banks are also making a lot of progress in the sort of direction that we had indicated back in 2018, 2019. If you remember, we talked about the new normal. We also introduced, we pushed banks in the context of the new normal to begin working to be more resilient. You know, sort of strengthen their business models, strengthen how they do business, including how they relate to customers, etc. But specifically strengthening their business models so as to be more resilient and survive shocks that will come in the future. And we did say then that some of this would come from, would be through, let's say, consolidation. And we talked about that. And I hope you acknowledge that there has been significant consolidation in the sector. It is true, some of you were pushing us to be, much more aggressive. And we said, no, we want it to be market-based. And I think that has really helped us. And indeed, even in the depths of 2020, there were significant announcements that were made, both in terms of our banks consolidating here, and also getting other, let's say, strategic investors coming in, and also our banks taking on investments in other jurisdictions. So that is something that that is happening. Now, of course, we also know that 2020 was not kind to progress, meaning there were delays, and in some of the institutions, there were delays in terms of taking the next steps, because after all, some of the shareholders were hit in terms of their liquidity positions, and therefore making investments, etc. Was, they weren't fully ready to make those investments at that point in time. Obviously, with the stability, and we should say, returning not just in Kenya but around the world, you can expect that those plans will be progressed, and we will see a continuation of, let's say, strengthening of those banks, not just additional capital, but also additional, let's say, new strategic investors and new business models, etc. So I think that is actually a bright spot for our sector, and we look forward to seeing more, let's say, more visible results in that area.
The last batch of questions, I'll begin with Wanderi Gitogo from the Economic Weekly. I believe this question has been asked. What Wanderi was asking is, what are your expectations on the impact of the new containment measures? I believe that has been handled. The other two is from David Ndeje of Husoko, who asks, is there more space to cut interest rates further to boost economic growth? And finally, from David Herbling, how much is Kenya expecting from the World Bank DPO before the end of this financial year?
Okay, so David, I don't have the number here, but you can ask others, National Treasury or the World Bank. I'm sure they have those numbers. In terms of, I think I've also answered Wadiri's question, expectation on the impact of the new containment measures. I think I've explained that things are still it is still unclear as to what exactly the impact is in terms of the containment measures, because we don't even know how long they're going to be. They're going to last. But I think here I take this opportunity to encourage everybody who's listening to take these measures seriously. Not just this, but all the other measures in terms of protecting ourselves. Let's protect our people. Let's protect ourselves. Let's be our brother's keeper. And then finally, the question about David Ndeje's question about space to cut interest rates. There is definitely space to cut interest rates. I mean, they're at 7% in terms of the leading the indicative rate. But I think the point here is it's not just interest rates. And I think this is the point I made earlier. When you do that, you're working more on demand side, meaning demand management. But I think there are other measures that are needed. If you really want to boost the economy, at this moment, the measures that will have the most, let's say, impact are not the sort of demand management measures. It's actually the structural measures. And for instance, we talked about the flowers. I mean, the flowers is not what they really need, the flower farms. What they really need is more space, more cargo space. And that can be done. So let's be clear where the constraints are. It is important to be selective in the way we do business. It's not, having a very generous sort of using, you see, well, maybe I should put it differently. You see, there's a danger here that if you have a hammer, everything you see looks like a nail. Okay, you know that expression. And I think that warns us to, if you have a hammer in your hand, don't just go banging on things. Ask yourself, is this the right tool for this situation? Maybe you need a screwdriver instead. So let's be specific, let's be selective, and let's direct policies to the right, in the right areas for the greatest outcomes that we are looking for.
Thank you very much. That was the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge, winding up his post-MPC press conference. We have it every time we have a Monetary Policy Committee meeting. We thank you for joining us this morning. The next one will be after the next Monetary Policy Committee meeting. As the Governor indicated, there's quite a number of documents which will be shared publicly through our website and our social media channels, including all the surveys that were mentioned and a lot of other documents. But for now, thank you and see you next time.